Welcome back to the CPA Revolution. I'm Sharina Padilla here with our tax strategy expert and co host, certified tax coach and CPA, Jose Ortiz. If you are tired of traditional reactive CPA advice and want to turn taxes into a wealth building tool, you are in the right place. Hi, Jose. Good morning again. Jose, how was your weekend?
Good. It was good. Can't complain. This Labor Day weekend, just got a little bit of rest before we have the next deadline coming on the 15th for S-Corps, partnerships and so forth. And thought it would be a good time to talk a little bit about S-Corps. Serena, in your experience, have you ever heard of what is called BASIS?
Have
BASIS.
and I deal with it with my personal business, but to be honest, I don't understand it enough, and I'm stuck in that level of how do I get to
Yeah,
to to the next point to increase my basis and make my business stronger. Um,
right.
but yeah, I would love to learn more about what you have to share with us today, and I will be asking some questions along the way.
Absolutely. So you know how we have a great working relationship, and you know how you'll send me some of your value clients, because obviously they need help with their tax, or they have a CPA that's kind of like forward thinking enough to kind of help them. But a lot of the times when these clients will come, and you know how we'll do the errors and missed opportunities report if we see that they're a good fit. Well, during that time, I'll get a lot of people who have S corps. And the thing about it is, I'll ask them, well, what prompted you to elect an S corp? And they'll usually tell me something like, well, my former CPA told me I'll save money on tax, or I went online and I saw one of these tax guys, these tax influencers saying how much they save money on tax. All true to a certain degree, right? You save money on self-employment tax. Uh, there's a compensation that you pay yourself, and then there's distributions and all that stuff, which I'm going to get into that because I'm going to get into that in a future episode, because that's important in and of itself. But
But just
just
so I
yeah,
understand this correctly, the way I see it is that without being able to track that basis, the S Corp could be costing you more than what it's saving. Is that what you're saying?
it possibly can, and it's one of the biggest errors. Well, yeah, I would say errors when I come across tax returns when I'm reviewing them, right?
Mhm.
So what winds up happening is, again, people don't know, so they'll say, hey, I can save money on taxes, go for it. But what the CPA that they're working with um, doesn't know or doesn't tell them is that there's this thing called basis. And while the S corp can seem like the ultimate hack, right?
Mhm.
This is kind of like, I would think about it maybe like a landmine, right? A couple of landmines that you need to consider. And this is why it's so important for business owners to understand this stuff in order to be able to ask the right questions. So what I'm going to do today is I'm going to give you guys out there information about basis, but then I want you to take that back to your CPAs and ask questions so that so you can kind of gauge whether they're aligned in that thinking, as far as, hey, we have to kind of look at this and look at these different factors because it could affect you at the end of the day. So
Mhm.
let's get into a little bit. So basics is, what is it? Um, Kind of think about it like an investment tracker in your business, right? So basically, you start off your business. Let's just say you started off as a LLC, right? Single member LLC, whatever it may be, and you put $50,000 in, right? Well, that $50,000 is your initial basis. So I got $50,000 in, right? And we're going to go through a little example in a while. But I put $50,000 in. Let's just say I have make $25,000 that year. So my basis is 75,000. Let's suppose the next year you have a loss of 10,000. Your basis is now 65,000, right? So in concept, in theory, it's easy enough to understand, right? So we're tracking basically what the investments are into the company going in. So there's three different types. The stock basis is kind of what I was just talking about. You put you put your initial contribution in. It's increased by profits and new contributions. and it's decreased by losses and distributions. But what happens if nobody told you that? Let's just say this example that we're talking about, where you $50,000 in, this person's CPA says, "Hey, go ahead and switch over to a S-Corp," and then they have a big loss the next year. Let's just say it was $25,000. Well, they only put $50,000 in. They lost 75,000, and let's just say they maybe took out 20,000 in distributions. What happens there is you have no basis. So anything that's considered that you take out in distributions is kind of considered a return of capital. And that's taxed at capital, long-term capital gains rates, 0, 15, 20, right? So then this is where I see all the mistakes. And then some people will come and say, "Hey, my CPA told me I would save with the S-Corp. I don't see it. I'm paying long-term gains and I have no idea why." Well, that's why, because this is like a skin in the game kind of thing, right? So the IRS wants to see, obviously, do you have enough stock basis, right, to support those distributions that you're making yourself? That's just one. And let's go into kind of like a little example here that I have. And this, by the way, guys, you can follow this in the actual article. I'm using the same example, but I just kind of obviously want to talk about it in person with you. So let's call this person Sarah. Sarah made the $50,000 contribution to start her S-Corp. So over 3 years, her K1 shows $100,000 in profit, right? She takes out 120 in distributions, right? So we have 50 plus 100, 150,000, right? And then she took out 120 in distributions. On top of that, now she goes and invests in new equipment and claims $80,000 of bonus depreciation. We've covered that. So we all know how that works. And she spends another $40,000 in research and development, tax credit eligible projects, right? So she thinks that she's on top of the world, right? Because she's figuring this stuff out. She's like, "Hey, I'm doing all these right things," and she is. But here's the problem, right? Her CPA isn't tracking stock basis, right? So on paper, she thinks she's wiped out that bill, right? With depreciation, with credits. But let's kind of go into it. Sarah's stock basis is only 150,000, right? That was a 50K plus the 100K. And then her cumulative distributions and deductions exceeded that amount. So what winds up happening? The bonus depreciation and the R&D deductions get suspended, and $20,000 are reclassified as taxable long-term capital gains, right? So if you don't know that stuff and you think you're doing the right stuff, going in and being proactive in tax planning and taking advantage of all these things, and then you get hit with that, right? Then you're a little bothered, right? And that's exactly what usually happens. It's like people don't understand the rules of the game. They come to me, I spot the errors, and I have to tell them about it. So that's one. That's stock basis. Then there's
so let me just recap this for our listeners, because I know you said a lot, and we want to make sure that you as a business owner, you understand what a stock basis is. So, and correct me if I'm wrong, Jose. So the stock basis, it's always increased by the profits and contributions, right? Yes. And then decreased by the losses and distributions that you're taking as the owner.
That is
and
correct.
Without tracking those items, you may be losing deductions, and then invalidate some of the strategies like bonus depreciation and R&D and the taxable distribution. So it's very important that you understand these differences and how those items are being tracked by your accountants.
Exactly.
Right. All right. And there.
Okay. You got it.
All right. Yep. So what's number 2? I know you said there were 3 kinds of bases.
Right. All right. So number 2, Sharina, is debt basis. So we have stock basis, we have debt basis. What is debt basis? Debt basis it comes from the money that I personally loan to the business, right? So if I give you a $50,000 loan, or my business a $50,000 loan, I have debt basis of $50,000, right? So what happens? So basically, if I've loaned a $50,000 from my own pocket, right? I create the debt basis. And now if I have losses, right? So basically the losses hit stock basis and then they hit debt basis. And if I have debt basis there, then I can claim the $50,000 in loss, even if I don't have the stock basis, right? Right. So basically here I have the $50,000 where I can actually receive back in distributions, and then of course I have to restore that debt eventually. So these are the kind of things that I don't want to get into the nuances of it, but just basically kind of think about it like, hey, I loaned 50,000 to the business. I have now 50,000 in debt basis, which again, if I have outdrawn my distributions on a stock basis side, I can also use that debt basis. All right. But what you want to do there is you don't want to have that negative basis for that basis forever. So you want to either loan, do a loan, whatever it may be, or basically pay it back eventually or whatnot.
Right.
But the whole idea is you want to be working with somebody who understands this, so that way they can kind of tell you, hey, we're going to be able to use your debt basis. However, these are the consequences moving forward. Right. So that way we're all aligned, and the business owners knows how things are going to look moving forward. So that's debt basis.
So the debt basis is the money that you are investing to either start your business or start another initiative to grow your business. So you want to bring money into your business, and it's going to be recorded as a debt. And this doesn't mean loans from banks, right? It's your own
Right.
money that
That's the
you're
big thing.
putting into the business, right?
Right.
So
Exactly.
um,
And that's what people get
without
confused.
having this debt basis logged properly, you're going to be wasting some losses that you can't deduct. So
That's right.
it's very important that you know the difference between the debt basis, that's money coming from you, versus the stock basis, that it's the profits that your business is producing. And if you're taking those distributions, you've got to make sure that you're replenishing that debt to keep your business healthy and
And your basis.
wealthy. Yeah.
Yep. So let's go into another little example here. Now we're going to talk about debt basis. Okay. So this guy, Jose, right? He owns a marketing firm. It's an S-Corp, right? They had a bad year, showed a $75,000 loss, right? He only has $40,000 in stock basis left, right? So there's that stock basis.
Mm-hmm.
If he had loaned the business $50,000 from his own pocket, then he would have created the debt basis that would have been allowed him to deduct the full $75,000 loss, right? Because obviously he had $40,000 from a stock basis, right? And then he loaned the company $50K. When you put those together, right, you have $90,000, $75,000 loss. He could have deducted the whole thing. But a CPA never mentioned that whole thing, the whole scenario with debt basis. Instead, he only deducts $40,000 this year, right, out of the 75. So only $40,000, and then what happens to the $35K for the rest of the loss? It gets suspended moving forward. So obviously, that's $35,000 of wasted deductions, and it's going to cost him more than maybe about $10,000 plus in extra taxes.
All right, Jose. So what is the third kind of basis that we need to learn about today?
Right. So that one is at-risk basis. Right. So basically, the IRS wants to see that you have skin in the game. You're going to lose something, right? If there's a loss, right? So at-risk rules make sure that you're really on the hook for those losses. Even if you have stock or debt basis, you can't deduct losses if you're not actually at risk, right? So let's just say, and for a case study example, let's just say Lisa. Right? Lisa has an S-Corp. She gets the $200,000 loan secured for company equipment, only by company equipment, not by her. This is the big thing, the big difference here. So she goes out, gets this $200K loan secured by the company equipment, right? CPA tells her, hey, no problem, that's basis. Is it basis though, based on what we just learned? No, she's not under risk. She didn't personally guarantee that, right? So she has no skin in the game. So here's what happens. She deducts a $50,000 loss against her income. Here comes the IRS and they audit them. She's that lucky. She got audited that year. And they determined that that's how it happens, right? She determines that the loan wasn't personally guaranteed. So the IRS says, hey, no, that didn't count. I don't care what your CPA put on that tax return. It didn't count. So that $50,000 loss is disallowed. Here come penalties and interest now. And now she's out, say, $15,000. And now she has a target on her back because now the IRS is saying, hey, Now we got to monitor for future audits. Okay, so you see how that all can, and this is something we want to mention because I don't hear people online talking about it. Number one, right?
Right.
Number two, these are things that really impact your ability to plan, your ability to tax plan, right? So your
Right.
CPAs really need to kind of pay attention to this because even this is a tax planning opportunity, right? So it
I get it.
matters.
And it's so, so important. And we hear tax planning and tax strategy everywhere, but there's
Yeah,
so many nuances. And that's why it's so important for business owners to be informed, to make sure that they're keeping proper documentation.
yeah,
Communication with your CPA is key. If you don't understand something, ask the questions, because
right,
something simple as the basis of your business can turn into
yeah,
these issues with tax bills and penalties. So if your CPA is not familiar with these items, maybe
yeah,
this is not the area of expertise for them. That doesn't mean that they're not a good CPA. That just means that there's room for improvement, and there are consultants and tax coaches out there that can help bridge that gap. So,
right, yep,
just to recap real quick, the at-risk basis, you can only deduct those losses to the extent that you're personally at risk for, right? And those
exactly,
non-recourse loans don't count. So,
exactly.
just like you shared in Lisa's example, this is a huge area of opportunity where we can all come together and make sure that we're understanding those three different types of bases that we need to be looking at for our business to make sure that all of our records are aligned and uh, we have a strong foundation to continue growing our businesses.
Right, exactly. So if you remember nothing, take away these three things. Why basis matters, right? Losses, right? Without basis, you can't deduct losses, period. That's it.
Mhm.
Distributions, when you take out too much without the basis, now you're facing tax, right? And the whole
Right,
point of this whole thing, remember what the whole point was? To save on tax. And then
right.
number three, audits, right? Without being at risk, you're paying it back with penalties and interest, right? So not a good place that you want to be in. But that's why we're here. This is why, and obviously we recognize the gap here at CPA Revolution, and this is why this information is so important, because now you can take this information, look at your own personal situation, or have us look at it, or take it to your CPA, gauge the knowledge, and then make a decision as far as how you want to move. But as always, I want to leave you guys with the strategic moves, right? So I'm not going to just tell you about it. So what kind of things can we do to ensure that we have basis? You got to track it. Simple enough,
Mhm.
right? We got to track it. You find somebody that can track it, right? Very simple. But
For sure.
as far as strategic moves, hey, structure shareholder loans to intentionally build basis, right? If we know that 5 years out, 4 years out, however what long it is, that we're going to have a down year, right? And we're going to need to swallow up as much of that as we can, right? Can we intentionally build basis by loaning the company money? Formal loans, real loans, arm's length, all of that kind of stuff that the IRS requires, but can we do that, right?
Mhm.
So everything I'm saying is how can we, right?
Yeah,
So
for sure, for sure.
tracking stock basis annually, that's what I just said. So we don't want those phantom taxable gains, right, that we didn't see coming. Coordinating basis, and this is super important because I like to talk about exit planning as well. Coordinating
Mhm.
basis with the exit planning, right? So you don't blow up your exit with unexpected taxable income. So you can imagine you're retiring, and then you find all this stuff out later, and then you get hit with more tax. And then using basis to plan proactively, right? Alongside all these other strategies. We talked about it. Cost segregations, right? R&D. How can we look at all of this within one lens and plan
Mhm.
accordingly? So if I know I'm going to make a big R&D expense next year, don't I want to make sure that I can be able to take advantage of those credits? Yeah. So
Right.
I want to know where I stand with that. So super important stuff, but just like again, like you said, tax has a lot of nuances, but these are the kind of things that business owners, homeowners, wow, business owners need to know. Obviously, there's so much that you can abdicate to a CPA, but again, this is your horse, right? And this is your race,
Right.
so you want to make sure you're on top of that.
Yeah. And let's keep the conversation going. We appreciate everyone that's listening to our podcast.
Yeah,
And we always want to leave you with those golden nuggets so you can make sure that you understand what you're doing to continue performing at the highest level for your business. So if
yeah,
your CPA is not tracking your stock basis, your debt basis, and your at risk basis every single year, they are not protecting you. They're just processing paperwork. That's why average isn't enough, right? And that's your line, Jose.
that's right.
So
Yeah,
basis planning is what keeps deductions real, right? And
exactly.
distributions need to stay clean, and your future exit uh, plan needs to make sure that it's free from surprises or tax bombs, right? Don't
Exactly.
just file paperwork and hope that the software handles it. You need
Exactly.
to know and ask the questions. If your CPA is not sure, ask other CPAs. There's so many resources at your disposal,
Yeah,
and you cannot stop until you get a straight answer. So make
exactly.
sure that the strategy matches the size of your ambition, because when it
Exactly.
comes to your future, average is not good enough. It's freaking expensive. So let's get on with it. And I look forward to hearing uh, about your questions, your concerns. We're happy to point you in the right direction to the best of our abilities.
Yep. And just so you know, because everybody asks, man, I wish I had somebody that can confirm this information that my CPA is giving me with somebody, somebody I could reach out to. That's why we have our chat feature, guys, right? I care about you guys as business owners, and I want you guys to succeed. This is why I have this available for you guys. So use that chat feature, ask questions, um, you know, ask any guidance that you might need, and let's take it from there. And I can help you guys as much as possible.
Right. So, what are we talking on our next episode, Jose?
We are going to talk about the new car deductions for vehicles, right? A lot of people forgot about they know about the clean vehicle stuff, and that's going away this year. But
Mhm.
a lot of people haven't been told or haven't been educated on the new deductions that are available. So looking forward to talking about that.
Beautiful. Well, looking forward to it. And I know that we're going to continue learning together. And thank you so much for answering my questions. And look forward to not just file my tax returns. I want to continue planning smart.
There you go. Take care, everybody.
All right. Sure.